How inflation, debt, and policy quietly redistribute wealth. That sounds abstract, technical, maybe even distant from everyday life. But the truth is, this process isn't happening somewhere out there in financial markets or government offices. It's happening in grocery stores, in mortgage payments, in paychecks and savings accounts. And most people never notice it in real time. Because wealth redistribution, at least in modern economies, rarely looks dramatic. It doesn't show up as sudden loss. It shows up as gradual adjustment, small shifts that feel manageable on their own, but compound into something powerful over time. To understand this, imagine two people living in the same economy. One keeps most of their wealth in cash, savings, and fixed income. They value stability, predictability, and security. The other holds productive assets, things tied to growth, scarcity, or leverage, businesses, real estate, or tangible stores of value. Now, imagine inflation begins to rise. Nothing catastrophic, just a steady increase in prices. At first, both people experience the same thing. Groceries cost more, services cost more, energy costs more. Life becomes slightly more expensive. But beneath that shared experience, something very different is happening. The saver's purchasing power begins to erode. The asset holder's position begins to adjust. And this is where redistribution begins. Inflation is often described as rising prices. But that description misses the deeper mechanism. Inflation is fundamentally about the changing value of money itself. When the supply of currency expands faster than the production of goods and services, each unit of money represents a smaller claim on reality. It buys less time, less labor, less material, less energy. No one reaches into your account and removes dollars. Instead, those dollars quietly lose capability. This distinction matters because erosion feels different than loss. Loss triggers action. Erosion often goes unnoticed until it has already compounded. Now introduce debt into the equation. Debt behaves differently under inflation depending on which side of it you stand. For borrowers with fixed-rate obligations, inflation can act like a slow reduction of burden. The money used to repay the debt becomes less valuable over time. In real terms, the obligation shrinks. But for those without leverage, or those whose wages fail to keep pace, inflation compounds pressure instead. Living costs rise while purchasing power stagnates. This dynamic doesn't punish or reward people equally. It shifts advantage. And those shifts scale upward across the entire economy. Governments, corporations, institutions, and households all interact through debt structures. When monetary conditions change, the redistribution effect cascades through those layers. This is where policy enters the picture. Policy decisions rarely declare themselves as redistributive. They're framed as stabilization, stimulus, support, or protection. Interest rates are adjusted. Liquidity is expanded or contracted. Lending conditions are shaped. Regulatory environments evolve. Each decision has second-order consequences. Lower rates may stimulate borrowing and asset expansion. Higher rates may restrict access and consolidate ownership. Monetary expansion may elevate asset valuations. Contraction may compress participation. None of these outcomes are evenly distributed. Those closest to capital flows, institutions, asset owners, leveraged participants, tend to experience effects earlier. Those dependent on wages or fixed returns often experience effects later. Timing becomes advantage, and advantage compounds. If you look back across decades, this pattern appears repeatedly. Periods of monetary expansion often coincide with rising asset valuations. Not necessarily because underlying productivity changes overnight, but because liquidity reshapes pricing dynamics. At the same time, currency holders experience gradual dilution. Again, nothing dramatic, just a widening gap. This gap is often misinterpreted as individual success versus failure, but at scale, it reflects systemic mechanics. The system itself creates pathways where wealth gravitates towards certain structures during certain phases. Understanding this doesn't require cynicism. It requires observation. Consider how policy responses during economic slowdowns are designed. Stabilization efforts often prioritize systemic continuity, ensuring credit markets function, institutions remain solvent, and liquidity circulates. These objectives protect the architecture of the economy. But protection at the structural level doesn't always translate evenly at the individual level. Because the transmission channels of policy, banks, markets, lending facilities, are not accessed uniformly. Participation is uneven, access is uneven, outcomes are uneven. This unevenness is redistribution in motion. Another overlooked factor is expectation shaping. Policy doesn't just move capital, it influences behavior. Forward guidance, signaling, and narrative framing shape how participants position themselves. When borrowing is encouraged, leverage expands. When caution is signaled, contraction follows. These behavioral shifts feed back into asset flows, pricing, and ownership distribution. Over time, they reshape who holds what. And this reshaping often occurs without a single dramatic moment marking its progress. Historical examples reinforce this pattern. Inflationary decades have repeatedly reduced the real burden of sovereign and institutional debt while compressing savers' purchasing power. Monetary tightening phases have frequently transferred opportunity toward those holding liquidity or resilient assets. Post-crisis interventions have elevated asset valuations while leaving wage growth lagging behind. Different eras, different narratives, same structural mechanics. What makes modern redistribution especially subtle is technological mediation. Digital banking, automated investment, and frictionless transactions create a sense of seamless continuity. But beneath that seamlessness, flows still occur. Value still migrates. Ownership still concentrates or disperses based on systemic forces. The interface has modernized. The mechanics have not. It's also important to recognize that redistribution isn't inherently malicious or benevolent. It's structural. Complex economies constantly rebalance incentives, obligations, and resource allocation. Redistribution is one mechanism through which this balancing occurs, but neutrality of mechanism doesn't mean neutrality of outcome. Those outcomes depend on awareness, positioning, and adaptability. Preparation, in this context, doesn't mean attempting to outguess policy or predict inflation rates with precision. It means understanding the directional pressures at work. It means recognizing that holding only nominal claims during periods of expansion carries different risk characteristics than holding productive or scarce exposures. It means viewing debt not simply as burden or opportunity, but as contextual, dependent on monetary environment. It means understanding that policy is not background noise. It is an active force shaping distribution pathways. And perhaps most importantly, it means acknowledging that redistribution rarely announces its arrival. It accumulates, gradually, persistently, quietly. By the time it becomes obvious, positioning opportunities are usually reduced to reaction. Throughout financial history, those who navigated transitions most effectively weren't necessarily those with superior intelligence or access to prediction. They were those who studied structural patterns and aligned accordingly. They observed relationships between money creation, credit expansion, and asset response. They recognized the asymmetry between nominal stability and real value change. They understood that stability in appearance does not always equate to stability in structure, and they acted before consensus formed. Because consensus tends to form after redistribution is already well underway. So when we talk about inflation, debt, and policy redistributing wealth, we're not describing conspiracy or catastrophe. We're describing mechanics. Mechanics that operate continuously. Mechanics that shape outcomes regardless of awareness, and mechanics that reward observation over assumption. Understanding them doesn't eliminate uncertainty, but it reframes participation from passive exposure to informed navigation. Because wealth rarely vanishes within systems like these, it relocates from certain balance sheets to others, from certain structures to others, from certain assumptions to others, quietly, consistently, and often unnoticed. If you want more calm, research-driven breakdowns of how money, markets, and global systems actually function, without hype or sensationalism, make sure to subscribe to the channel.